Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. If you spend much time watching this network, you've heard endless chatter about the Federal Reserve, the business cycle, tariffs and trade, and of course, all the ways our trading partners try to get over on us by breaking the rules of the great arbiter, the World Trade Organization, or at least breaking them in spirit. But for all the relentless focus on the Fed or trade policy or the inherent boom and bust nature of the economy, we don't always do a great job of putting this stuff into context and explaining why it matters to you. And I include myself in this. There are periods of time when on any given night, you'll see me ranting about how maybe the Fed chiefs made a mistake in the fight against inflation or unemployment. Then he makes one statement. Suddenly I'm acting like the guy's the best thing since sliced bread. A responsible guy, a kind man, a good man who's doing an amazing job that the stock market absolutely loves, at least until the next meeting. See, there's a problem in financial journalism where we can get so inside baseball that we forget to lay everything out in a way that everybody can understand, even if you don't have a job at an investment bank or an economics degree. That's why my mission is to take these concepts and make them accessible, so home gamers like you can analyze stocks with the same level of rigor as the professionals, the same way we do with the CNBC Investing Club, which I think you should join. But there's only so much time in any one show, and there's a lot to cover every day. That's why tonight I'm stepping back and explaining everything you need to know about the Fed, the business cycle, macroeconomics. This stuff is essential. Don't worry, I'll make it interesting. You know me. Let's start with the Federal Reserve. We often act like the Federal Reserve is really all important. Right? The only thing we need to know, sometimes it's true, although mostly it's an exaggeration. You'll hear metaphors about the Fed when they cut interest rates. They're tapping the accelerator in the economy, causing it to speed up. When they raise interest rates, they're slamming on the brakes. You hear all this stuff. It does drive me crazy. Okay, so that's a pretty good shorthand that I just gave you. But tonight I want you to understand precisely how this mechanism works, rather than trying to tackle this on a case-by-case basis like we normally do. Higher rates are good for the banks, but bad for housing as mortgage rates rise. They're bad for autos as car payments go up, bad for businesses. It becomes more expensive to expand or bring in new inventory because of credit. In other words, I want you to know why so many of us fear the Fed in down markets, while at the same time looking to them for our financial salvation. Now, let me start by saying some stuff that should be obvious. The Federal Reserve is not some secret cabal that controls the economy from the shadows. They're not the Illuminati. They have no connection with the House of Thurn and Tax's postal system. In reality, the Fed's overseen by a board of governors, all of whom are appointed by the President of the United States and confirmed by the Senate. But once they're appointed, the President can't fire them, which is why we talk about it like an independent agency. So what is the Fed? It's a central bank, exactly like the central bank of every other developed country. These are independent government agencies that are in charge of monetary policy, meaning the money supply and interest rates, and they also regulate parts of the financial sector. When you hear me say the Fed's tightening or easing, I'm talking about short-term interest rates. See, by law, our central bank does have the power to set what's known as the federal funds rate, the shortest of short-term interest rates that banks can borrow at overnight with no collateral. When you hear the Fed's raising or cutting, that's really the rate we're talking about. So why does an independent agency set interest rates? Well, that's a great question. It's because our central bank has this, what we call, dual mandate from Congress. They're supposed to promote both maximum employment and stable prices. In other words, their job is to keep inflation in check without tanking the economy. Now, sometimes that means doing things that are very unpopular, like raising interest rates aggressively, which is typically very bad for the stock market, very bad for you. That's why you can't have elected officials making monetary policy. The fear is they won't be ruthless enough if they need to worry about getting reelected. That makes sense to me. So how's the mechanism work? How does short-term interest rates set by the Fed affect inflation and employment? All right, let's say the Fed takes the Fed funds rate from 2% to 2.25%. How does that tap the brakes on the economy? First, even a quarter-point rate hike makes it more expensive for banks to borrow money short-term. And you better believe the banks pass that on to you, the customer. So if you want a relatively short-term loan, it's going to cost you more money. Say you're a small business with a revolving credit facility. Suddenly, it's more expensive for you to borrow, which means you're less likely to expand. When money's cheap, it's easy to open a new location or hire new workers. But when borrowing costs rise, though the economics of expanding your business becomes much less forgiving, it becomes dangerous. Every time the Fed tightens, businesses get a little more cautious, and that reverberates through the entire economy. Eventually, as the pace of hiring slows down, the unemployment rate will start ticking higher. Look, we may even go into a recession. We've had many Fed-mandated recessions followed by just as many Fed-mandated recoveries. It's a cycle. Now, why would they want to throw so many people out of work? Remember, part of the Fed's job is to promote employment. But the other part, I think, is often more important. That's to stamp out inflation. And that same things that crush inflation also tend to crush the economy. When inflation gets out of control, you know what it does? It destroys a lot of wealth. And high prices make life miserable for everyone. Plus, as we've learned in recent years, inflation can be very difficult to stamp out if you let it get some speed. From the Fed's perspective, the most dangerous kind of inflation is wage inflation. Once businesses feel compelled to steadily raise wages in order to keep their employees, they have to raise their prices to pass on those labor costs to the consumer. That's really the story of 2022 and 2023 in a nutshell. Meanwhile, workers have more money to spend. That translates into more demand for just about anything, and thus higher price spirals. Suddenly, there's inflation everywhere. And those higher wages are meaningless because everything's gotten much more expensive. This is the main point, though. When you see inflation, that should scare you. Because that means the Fed will raise interest rates to stamp it out. They're going to do their job, even if it means sending the economy into a tailspin. That's why we watch the Fed like a hawk. That's why we debate how many rate hikes the economy can handle before it topples. And it's why I tell you that bad news is good news when the Fed's tightening, because the worse things get, the more likely it is for the Fed to ease up. It's also why it becomes easier to own stocks once the Fed stops tightening and starts cutting rates. The bottom line, we fear the Fed because the Fed sets interest rates. And if they get it wrong, they can allow inflation to run unchecked or do some real damage to the economy and you. We adore the Fed because when they get it right, the results can be very, very good for the stock market. Either way, as much as I like to talk stocks all night, I got to tell you, I can't afford to ignore the Federal Reserve. I want to start the calls with Steve in Florida. Steve.
Hi, Jim. Congratulations on 20 years of Mad Money.
You're very kind. Thank you, Steve. How can I help?
We've learned a lot from you.
Thank you.
My question is, buying an ETF like ITA in the defense sector, does it make sense to buy the best of breed in that same sector at the same time, like Lockheed or even Palantir?
No, you got to do one or the other. Got to do one or the other. Now, this thing, let me tell you the way this works. You get a lot of mediocre companies and some really great companies. I like AeroVironment because they make drones and they do a terrific job. You know I'm partial to Lockheed Martin. Either one of them is better than owning this because they're going to give you the mediocre ones but the good ones. Why do I want the mediocre ones? Let's go to Armin in Texas. Armin.
Mm-hmm.
Hi, Armin.
Hello.
It's Jim. What's up?
Hey, Jim. Booyah.
Booyah, Armin. Thank you for calling. How can I help you?
Hey, what do you think about YieldMax stocks? They give an incredible amount of dividend, 100% and plus. Are those safe?
I think it's okay. It's okay. I'm a huge believer that I got to know what I own. I don't like to own anything that I don't know that I own because I think I'm a discerning individual who can avoid the bad and pick the good. But I have a lot of time to be able to do this, and I've got some experience doing it. That may be good for people who just say, I want income, and therefore they feel they're diversified enough that they'll be okay. All right, look, I'm a stock guy first, but even I know that in this market, in any market, you can never afford to ignore the Fed. On Mad Money tonight, I'm demystifying the Federal Reserve and everything it does from quantitative easing to dot plots to so-called Fed speak and more. It's Fed night, and we're just getting started. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.